Welcome, everyone. Jeff Fratarcangeli here, Fratarcangeli Wealth Management, for another call to action market update. Those of you that this is your first time joining us, or will be watching the retape, Fratarcangeli Wealth Management's been around since 1995. This is our 30th year. We're comprised of 30 plus professionals with over 250 years of experience, focused on holistic wealth management planning. The obvious that you would expect, we monitor the markets, we guide and counsel our clients on how and where to invest in different vehicles, ranging from retirement to taxable accounts to corporate accounts. But we do many other things in addition to the asset management and the investment side, which we do every day, and which is why we're here today to talk in more detail, as I think we're at a crossroads. But it's important to mention we do estate planning. We look at both sides of the balance sheet, both the assets as well as the liability, to make sure that we're getting good guidance and have a leverage team around our clients, guiding them and giving them solutions to their businesses and personal needs. In addition to that, we look at tax planning. We work with other professionals as well as look at their tax situation and make sure that we're cognizant of the guidance we're providing and the impact of taxes. Well, we look at the balance sheet on the liability side, we're looking at their expenses, which involves benefits. And we've made it our business to make sure our clients are cutting edge as this ever rising cost of benefits with healthcare and other forums, that we want to make sure our clients are getting the best guidance out there from the folks that are most reputable that we have access to. So it's a culmination of factors that the team and I are very focused on. And I got to tell you, I'm extremely proud of my team. We're dedicated. We built a culture that puts the client first and focused on their experience. And we've been ranked recently by Forbes number 22 in the nation, as well as number 1 in the states that we're attached to. That was this year's report. And as well with Barron's in the last 2 years, we were number 10 in the nation for independent advisors and number 19 of all the advisors in the nation. I'm very proud of my team's hard work that brought us to that level. But in addition to that, our hands on deck in times like this. Here we sit today with the market starting to bring in heightened volatility, which, be quite honest, we expected. But when it's here, it certainly is eye-opening and polarizing. And so we call in our key, call it folks on the front lines that I've learned to know and trust and utilize to a great deal. And before I bring on and ask them their first question and introduce them, just some basic facts that we're seeing right now in the market that I believe is causing a great deal of this, call it uneasiness and volatility. First of all, you have the tariff talk and the uncertainty that tariffs bring to the market and how they're going to impact potentially inflation. We have a number of other uncertainties as we sit here today and move forward with the new administration, with new policy, new agendas, and changes in certainly folks that are leading in those categories, including DOGE, which we talk quite a bit about these days on the news. But let's take a step back and let's look at the numbers. And the numbers are so important. You have a 10-year Treasury that's at 4.25% as of this morning. You have earnings that just came out and we're at 97% complete with the S&P 500 for the fourth quarter, which is the most recent reporting that we have. And what's interesting is we've had 75% of those companies report better than expected top line earnings, while 63% have reported better than expected revenue earnings. And we sit here today with pretty consistent beats by an average of 1%. And those are some pretty strong earnings beats that we've seen pretty consistently the last couple of years, which would lend the thought of the market must be performing on that news. But yet we see some volatility that we'll talk more about. Year over year earnings growth, we're looking at 18+% earnings growth. We haven't seen those types of numbers since post the call it COVID shutdown and pandemic. We're looking at future earnings, which guidance has brought us recently to over 11% earnings growth anticipated by the S&P 500 from the first quarter through the end of 2025. I'm going to tell you, I haven't seen that type of earnings growth going back even further than 2021. So we're seeing some pretty good outlook relative to earnings. And yet we sit here today with some concern on the recent volatility and market reaction. And one last point I'm going to bring up is the valuation. You know, what is the market's current valuation, or something called price divided by earnings? Relative to the future earnings outlook for 2025, we're looking at a 21 times earnings PE ratio, which is a little bit lofty when you consider the fact that over the last 5 years, the price to earnings ratio has been closer to 19%. But another factor that I mentioned earlier is the fact that We have an interest rate environment that we believe is going to be consistent. In other words, we don't expect rates to potentially rise. We're not sure if they're going to be reduced either, but we have a 10-year treasury at, like I said, 4.25%, and that's a direct correlation because the higher the interest rates, the lower the PE multiples are, and the lower the interest rates, the higher the PE multiples tend to be. And here we sit today with a little lofty as it relates to valuation, but also a pretty contained interest rate environment. I'm going to start with, I'm going to introduce both of you, and I'm going to start with Gene, you, as to what you think the markets and economy is looking like and what you're anticipating. But Gene, those of you that do not know Eugene Peroni, who's someone that we've leaned on for over a decade. He is one of Wall Street's most respected equity strategists with over 45 years of investment analysis experience. He's most regarded for his Peroni methodology of his selecting stocks pioneered by his father over 50 years ago. He's a regular on many publications and talk shows, including CNBC, Nightly Business Report, along with many other, including this, I imagine one of your most sought after places that you're seeing on TV. We appreciate you, Gene. I'm going to come to you in a second. But before I do, my second guest is a gentleman by the name of Bernhard Koepp. And Bernard's someone that I love leveraging as well for his fundamental and analytical view. And I really like the fact that he comes from an international perspective as well as a domestic perspective. I really like building the two together and getting really direct to the point advice and feedback relative to his outlook. And Bernhard has heads up he's the CEO and managing member of the CJ Lawrence Group, which manages over $10 billion. Very impressive group. Bernhard is one of our favorite guests, and I usually lean on him when I really am questioning where we're going next, like I do Gene. Gene, you're the technical analyst. You're the one that gives us sign of the support and resistance. And, Gene, I call you pretty consistently as well. What says you? What keeps you up? What's your outlook? Where's the opportunity? Please.
Well, Jeff, stating the obvious, the market's on the defensive and investor psychology is shifting. It didn't just happen at the start of this year. I think we can really trace it back to the fourth quarter of last year, where we began to see this shift. And what's happening, I believe, is that the psychology is shifting from one of great anticipation to one of more expectation. And this is particularly reflected in technology, in the aggressive growth areas of the market. There is some disappointment that companies like NVIDIA that reported very strong earnings didn't really respond very strongly to the latest results. And I think, again, that this goes back to the fact that now investors are beginning to expect a little bit too much. I guess you could say they've been a little bit spoiled by the strong growth, not just in companies like NVIDIA, but other aggressive growth stocks generally. And so what is happening here is not an exodus from the stock market. It's a realignment. It's an adjustment of portfolios. And while growth has really ruled here for the last several years, I think there is likely to be more of a balance in 2025 and maybe even beyond, especially while there is the uncertainty of the tariffs and of Doge. So what we see so far this year is a blue chip index, the Dow Jones Industrial Average, leading the other indices. The Dow is up about 3%, while at the same time, the NASDAQ is actually down by about the same amount, and the S&P is up just about 1%. So clearly, just on the top-down view, there is a movement from the more aggressive growth areas to the perceived safe haven of the blue chip and mega cap stocks. I don't think this is temporary. I think that the Dow is going to be the leading index this year. And we'll see the other areas, the growth areas coming back, but they have their work cut out for them. As I've said in the past, I'm not so concerned about the downside exposure or the risk. I'm more concerned, at least over the short run, about the limited upside because of the many rally failures that we've seen since last October. So this is going to take some work off. And with that, we're going to see these expansive trading swings likely prevail over the next several weeks to several months.
I'm going to follow up with a question Gene, but I'm going to turn to Bernhard. Bernhard, coming from a different vantage point, what would you add to, or what would your comments be relative to what your outlook is?
Yeah, thank you, Jeff. Look, I mean, I always enjoy this call because you have one of the best technicians, technical analysts on with Gene and his methodology. And we're a fundamental bottom-up shop. So it's always fun for me to compare notes here. And typically when we're aligned, then things are really good. And I think, look, I mean, Jeff, the last time we had this call, we were kind of thinking about an outlook into 2025, coming off a very, very strong year in 2024 in terms of markets. So we were really excited about the fundamentals going into 2025. And with the election, so we had the election, we had two rate cuts in the fourth quarter. You had a little bit of a sell-off, as Gene said, in December. But wow, the setup with the new administration doing deregulation, being pro-business, no taxes going up, fundamentals, as you said right at the beginning, Jeff, we have not seen double-digit earnings growth for 3 straight years, more than 4 times since the Second World War. Okay, so we highlighted this, my partner, Terry Gardner, we highlighted in one of our YouTube videos a while back. This is really, really rare that you have that kind of a strong growth setup. So from a bottom-up point of view, coming into 2025, we're really excited. So obviously what are the big sectors that are driving the market? It's really technology and financials. Financials all of a sudden took off. Once we had the election, November 6th, the financial stocks went up 10% that day, on the next day, because deregulation tends to help financials most. So if you take deregulation, and a lot of our banks after the 2008-09 crisis were overcapitalized. So if you take deregulation, you have a little bit easing of capital requirements for banks and financial services. That's really going to turbocharge the economy. So here we are a month, let's say 2 months later, we end of February, we still ended I think the month with an year-to-date positive numbers. So here we are. Where are we now? So normally, so we have the Doge, which and we all the things that the Doge is trying to do is really, really important. I mean, we cannot sustain 7% deficit or budget deficit to our GDP at 7%. That's not sustainable. We cannot sustain 110% debt to GDP. I'll give you an example. Germany has a 62% debt to GDP. So we are leveraged and running deficits like a third world country. That's not sustainable. So what the Doge is doing is really important, and the market likes it. So the market has not said, oh my God, this is austerity, because typically if you say austerity is the thing that kills multiples. I mean, I've always had this debate with my political friends, whether they're Democrats or Republicans over the last decades. And when my Republican friend said, oh, we really need to get the debt on the line, I said, don't wish for this too much, because if we do austerity, it's typically not good for the market. But what we're doing here with Elon Musk is something very unprecedented. I mean, he's taking an axe to the government, and things will break. And that is, we're seeing a little bit of the uneasiness regarding that. But the market is telling you, and if you look at treasuries and you look at the stock market, so far, the market likes that, because we cannot be on this unsustainable path of highly indebtedness and deficits. So then let's shift to the tariffs. I mean, normally, look, Jeff, I'm an economist by training as well. I'm a portfolio manager. I pick stocks by day, but I'm also an economist. And typically, austerity and tariffs is like the worst two things you could do to a market. But again, the Doge thing is very important, and we're doing it differently than in the past. So the market likes it, actually. And if you look at now the tariffs, okay, that's where there's a bit of a question mark. Can we get this done? I mean, The Canadian and Mexican tariffs are supposed to start tomorrow, and we're increasing tariffs on China by another 10%. We already have 10% on. So if that remains, it would be not market negative. But the market so far is saying, okay, hopefully rational minds will prevail and we will get some kind of a deal. And that's where the risk off here is happening to a certain extent. I mean, we're only off 3.5% from the recent high. So, you get calls, you see the volatility in the market or in individual stocks like Nvidia and some of the risk off names that are like 20% down just from the recent high. But the market's only off 3.5%. It's not a big deal yet. But the risk here is that on the policy side, we don't get things done. And that's where there's a big question mark. And look, we're watching it every day. The fundamentals remain really strong. The U.S. remains the strongest economy on the planet. So, and one of the things, statistically, you may find this interesting. We are 26% of the GDP of the entire world. 26%. The euro area, the entire euro area, is only 14%, and China is 17%. So take the fourth largest economy, which is Germany. It's only 7% of the global GDP. Okay, so we dominate. So and I would, if I was a fly on the wall or in the Oval Office or the White House, I would say, let's not mess this up. We can bargain, we can be strong, but we got to get these policy things squared away quickly. We have to be careful not to insult people. We can push hard, but we're already in the #1 position. Our equity market in terms of the globe is 60% in terms of size. 60% of the global equity market is the US. Fixed income, same thing, 60%. We're the only game in town. So, in that sense, we are at this crossroad now where we're going to get the job done, but the question is are we going to break stuff on the road to getting it done or not? And that's the big multi-million-dollar question.
Excellent. Both of you, very well put. I'm going to come back to each of you in a separate follow-up question, but I'm going to help interpret some of the comments made. I'm going to start with the most recent comments by Bernhard. Austerity, those that don't know what that means, it basically means you're sucking cash out of the system. Okay, there's something called M2 supply that we've been watching for decades. I've been doing this 30 years. I remember Greenspan walking across the street to the Fed meeting, and they were looking at his briefcase to see how thick it was, to see if he was going to have pulling cash out of the system or adding liquidity to the system. It's so important to have an engine with oil. Oil is the liquidity in the system. And we all remember '08 when there was an engine with no oil. That was the austerity of no liquidity or impact of liquidity being soaked up. And the big comment by Bernhard is that if we're doing Doge rather than austerity, it's better. It's what they're doing is they're trying to balance our budget, which has obviously gotten out of hand. And by cutting fat off the bone for areas that will not suck liquidity out of the system, like a Fed letting Treasury dollars go back into the Fed versus letting it stay within the system, it allows the engine to continue to chug along at these levels that have been so beneficial to our economy and the global economy. So great point there. I think the tariff comment is it what we're all thinking? Listen, the people have spoken. They voted for the current regime. They believe that he's going to be able to get this done without breaking something. And he, I'm sure, is focused on the exact same situation. You're going to have the narrative out there that's going to be, it's going to be what it's going to be. But they're working for the people is what I'm hoping, not the media. I'm going to go back to you, Gene. Excellent comments. And I intentionally didn't talk to either of you today, which you both know that I had the opportunity to. And I said, I want to hear you for the first time now, like my audience. And your comments is basically, Gene, that you're seeing a rotation. You're seeing money come out of the sector and the category of growth, and the tech sector being technology, where we've seen call it the rabbit, if you will, or the momentum move. And then you're seeing money go back to other areas that maybe a little bit more conservatively valued, as well as not as opportunistically performing the last couple of years, which are the blue chips, the areas of the market that are in the Dow Jones Industrial 30 companies, which are the bigger, stronger companies rather than the high growth companies. My question to you would be, and I'm just going to be so bold to throw it out there. You had NVIDIA come out and report better than expected earnings. I read the tea leaves. The narrative doesn't add up to me on some of the articles that I've read. And I won't go there because I don't think it's relevant. But they beat on the top line by a couple billion, and they beat on the on the revenue side by over $1 billion. And you have a company that's trading down from, call it, the mid 130s to, as we speak, 115. And you mentioned the momentum shifting, Gene. I'm going to press you a little bit. How do you have a company that has increased their outlook for earnings for the remainder of this year? You've heard comments that the chip demand is not going to slow down. Matter of fact, we still need twice as much as what's out there in the system. And yet you're making comment to the fact that you think that this is not a temporary thing where tech is lagging. You're thinking that it's going to be somewhat more sawtooth, as you put it, back and forth without breakouts. Maybe you can expand on that for me and my audience. You don't see an opportunity here? Is that what you're saying with the recent pullback?
Oh, I wouldn't say that I don't see an opportunity. I'm just saying that I think you have to regard what's happened in recent months with technology generally and the AI stocks, including NVIDIA more specifically. And if you go back to October, the stocks in this category, AI, have not been able to make any real headway since October. And they faltered and actually lost some ground since the recent high in NVIDIA at 150. I'm not here to say that I'm dismissing NVIDIA as a longer term opportunity. I think that it'll still will perform very well. And this is not a call to action just on the AI stocks or on NVIDIA. It's really just more of an observation that we are, on the one hand, getting rotation, but on the other, and I think Bernhard pointed this out so well, so the market's down with the NASDAQ's down about 3%, the Dow's up about 3% as of yesterday's close. But NVIDIA is down about 20% from its recent highs. So NVIDIA has been billed as being, the bellwether of the market, and everything revolves around NVIDIA and the Magnificent Seven. Well, here we have the Magnificent Seven, NVIDIA included, under pressure, and yet it's not really having a detrimental impact on the overall market. And I think this speaks volume about what I have been arguing for many, many years, why I have such a bullish stance through thick and thin. And that is that largely over the last 20 years and more, this market has had a number of different and diverse sectors participating very well, very steadily, and in a balanced manner. Now, yes, every so often, there's a company or a sector or a theme that falls out of favor for a time. But because of the other sectors and themes having a good participation and leadership, it doesn't disturb the overall market. And that's what we're faced with right now. There's just too much expectation now built into these tech stocks. This will change, this will dissipate. And once again, we'll see that anticipatory psychology once again come back, and the tech stocks will be timely. And again, I'm not advocating to necessarily sell the tech stocks. I think that they represent core holdings, but there's great leadership in industrials. Industrials, as of our most recent observation of the market, which is this morning, continue to be our highest weighting in terms of relative attractive. So if we're bottom up, we look at all the stocks in a particular category. The most attractive stocks we're finding right now are in industrials, keeping in mind that the S&P industrial sector falls under a lot, everything from railroads to aerospace and defense and so on. Healthcare is coming along here very, very well. So healthcare, which had been lagging, especially during some of the greatest moments of the technology rally, is really showing a very good relative behavior. So this is interesting too, because here we have RFK coming in, and he's kind of down on the big pharmas and cautious on pharmaceuticals. At least that seems to be the headline story. And yet we're seeing really good accumulation in a lot of the pharmaceuticals, biotech stocks like the Gileads and the Amgens and so on are trending toward their all-time highs. So there's a much different story told in the market. Bernhard mentioned, and by the way, Bernhard, thank you for your kind comments, and I feel just the same way. It's wonderful to hear your comments. I always believe if we can mesh fundamental and technically have the best of both worlds. But Bernhard mentioned the financials, and And yes, the financials have been showing the best relative strength over the longest period of time that I can recall since the financial crisis. Some would argue that without the financials participating in a significant way, the bull market cannot be sustained. And yet the financials are showing very good relative strength. So that's another category. The consumer discretionary group is another group that is showing very good relative behavior. So maybe we can really go down the list, and more sectors and themes than not are looking quite attractive to me from a technical standpoint, given the longer term view. So I'm more concerned about the near term. This resistance is going to be overcome. I think the Dow will probably be the first to pierce through it. I have a 50,000 target on the Dow by the end of this year. So I do think that good things are in store once we get through this period. And, again, Bernhard, I think is absolutely right. Doge, right now it's posing a lot of uncertainty, consternation. What is this going to mean to the near term earnings growth? Even though the earnings right now look great and all that, remember the market's forward looking. So it's wondering, well, is that earnings growth going to be sustainable? And right now there is that question mark. I think Doge is going to work out just fine. And remember, a lot of this Doge is really cutting peripheral costs and really just a lot of spending that is unnecessary. So it's not ripping into the core industries and so on. And that, by the way, applies to aerospace and defense. So Hegseth has the mandate to chop $50 billion off the Pentagon budget. But a good deal of that is personnel, not equipment, not supplies, not aerospace companies and the like. So the market, again, continues to telegraph for the longer term a bit more positive message. And if Doge comes through the way that many hope, myself, and I'm sure Bernhard included, then this market is just going to take off, because now you have a more streamlined U.S. economy that can better compete against international markets. You have an opportunity to cut the debt, and there might even be some helicopter cash coming along. So these are all good things down the road. So this is a short-term situation, and I think when you're in the midst of these uncertainties and anxieties, it's probably the best time to be thinking about buying.
Yeah. Yeah. Can I add to Gene's comment, Jeff? Can't hear you.
Oh, I'm sorry. I had you on mute. Excellent comments, Gene. Phenomenal. I'm coming to you in 2 seconds. I'm just going to make one comment, and I was coming to you anyway, Bernhard, and that is diversification, right? If we chase the hot dot, which of course the chip sector is and tech has been the hot dot, unfortunately, you're going to miss out on major opportunity. You have NVIDIA based on Friday's close of 26 times future earnings, and yet you have value companies trading in the mid-teens. In other words, they're 10 times less inflated. So you need to have a balanced approach to your long-term investing. And that was my only point, Bernhard. Yes, absolutely.
Yeah. No, look, I mean, this is a great conversation. So typically when the technology sector, so that's the biggest growth sector, and the biggest value sector, which is financials, both go up at the same time, that's the most bullish thing for a market. Because, typically when something's going wrong in the economy or there's credit risk bubbling up somewhere, then financials don't do well. And you have this, but we have this incredible technical configuration where you have value stocks and growth stocks actually doing really well. So just in terms of technology, look, we're big technology investors. I mean, we at CJ Lawrence, we've been investing in technology since the early 90s. I remember when the World Wide Web came about, it was very difficult for us to find stocks to invest in when the internet was first built, because all the action was with the small companies and not, there was nothing going on in the big companies. Today, it's completely different. There's something else that's happened here in technology other than the stocks have done really well. And it's this sort of moment, which was DeepSeek. And so this was the announcement out of China where all of a sudden there were this Chinese company that figured out how to do an open model to do AI. Okay. we can have a big debate about China and how threatening China is to us from a competitive point of view. Forget about that for a moment. We crossed the sort of the threshold of taking closed AI models, which are very, very expensive, and you need the best chips for that, the most powerful chips, to the moment where developers have cracked the code to do it open. So since that announcement at DeepSeek, a lot of these so-called infrastructure stocks in the AI space, their multiples have compressed. Not their earnings, but the multiples have come down. And the reason is we're at this, what we call the Moore's Law moment in technology, where the adoption rate of AI is going to accelerate. And as an investor, for us, that's incredibly exciting because now all these wonderful industrial companies that Gene likes technically and we like fundamentally are going to be able to adopt AI much cheaper than before. And you got also a little bit of the air, or the hot air came out of the electricity stocks, the ones that are solving the problems of electricity production. And the reason is because the new AI that's on an open model, and every developer around the world, not just in China, are now developing open models where you can actually embed AI in a much cheaper way than we had before, where you could only use the very high-end chip. So that's created a lot of consternation within the technology sector, and you had a lot of rotation from the high-end guys, the NVIDIAs, the Broadcoms, or whatever, into other things. And think of it as the stocks like Oracle or application software. All of a sudden, those have become really, really interesting. That's why there's been this rotation, but in the aggregate, not that much. So for us, that's incredibly exciting. And the last thing we would become here is bearish, because that is just giving us an opportunity to invest and into the next wave of technology adoption, which is going to be even more powerful than where we are right now. Because if you look at AI as an application, it's only 10% adopted in most companies. I mean, whether it's in the financial services industry or think of any services type industry or sector, the digital workforce that companies like Oracle and Salesforce and ServiceNow are rolling out, we're just at the beginning of that. And the productivity growth that's going to drive is just unprecedented. That's why margins, you would think at this point of the cycle, profit margins would be compressing, because yes, the economy is slowing, but no, margins are actually expanding, which is really amazing. And with deregulation, taking the costs of regulation out of the system, which, I mean, we have done some numbers on the cost of the regulation that was put on just in the last year by the Biden administration. It was 6.5% of GDP. It's huge. So you take that out, you can do everything from environmental projects, from wind turbines or solar farms, to drilling for oil and gas. You can do all these things in a lot quicker than it drives profits. So we're quite excited about that.
I've been in touch with you and listening to you and reading about where you think things. I don't know that I've seen you quite as optimistic, Bernhard. As a matter of fact, I would describe you as glass half empty historically. I love hearing your excitement, and I'm just going to comment on a few things. I'm going to press you. I lost audio for a second. I might not have heard everything, so I apologize if I repeat something you've said. But what I'm hearing you say is that the ability to access AI with the new technology being introduced sort of via DeepSeek is something that will be utilized in a more cost-efficient fashion, but it doesn't concern you in that you think the margins will continue to expand, even though the reaction short-term has been quite the opposite. And I'm going to push, correct me if I'm wrong, one, and then secondly, you brought up a good point that I was going to next, and I'm going to ask both of you the same question. Where do you see energy going? I know, at least what I believe I know, is that AI that's coming down the pipe, and that, as you pointed out, which I did not hear before, is being utilized at a 10% clip of where we're going. So that gives us, I'm not a mathematician, but 90% more to go. And the demand for AI is going to need energy to be able to implement. And we're talking about data centers, and we're talking about utility companies, and we're talking about different sources of energy. And you added to the fact regulatory deregulation that's going to allow these things to happen much quicker and efficiently. What do you see? I mean, you see the companies. I'm not going to get specific on this call for compliance reasons, but what do you see with energy? And then get ready, Gene, I'm coming to you next. How do we play it? At what percentage of exposure? And what's your concern, if not optimistic outview?
Yeah, so look, on the power generation side, that's a big component of our industrials weight. So that's where we see some really interesting long-term
Say it
growth
again.
on the power generation.
Okay.
So if you look at companies that are providing that are the problem solvers in the electricity space.
Okay.
And those are the companies that make gas turbines. Okay, and then those are the GEs, the Siemenses, and those people. So or people that do electricity efficiencies and things like that. There are very big companies that do that. So we love all of those. On the oil and gas side, we want to be a little bit careful, and it's not because of, I mean, deregulation is great for oil companies and gas producers also, for sure. But what we're seeing in the Ukraine with if that war ends in whatever form or shape, and Russian oil and gas comes back on the market, that's really bearish for oil prices. So from an equity investor in energy producers, I would be a little bit cautious there near term, just because there is a glut of oil and gas in the world right now. And if you add Russian oil and gas to that, it's going to make the glut even bigger, because we're actually producing more oil and gas in the world than ever before. So we're not involved in the energy sector per se, whether it's oil and gas, but more on the electricity production side. That's certainly where we're involved.
Interesting. Okay, Gene, you're on.
Well, as I mentioned, I do like the industrials very much, and yes, the power generation related companies I think are attractive here, especially on the pullback. Aerospace defense continues to be an area that I like very much here. We've seen the medium cap stocks in that category really outperforming the larger cap names, but now we're the larger cap names that were under pressure, presumably because of Doge and worries about Pentagon budget cuts, really coming back nicely. So I think that aerospace defense, which is a subcategory of the industrials, is certainly a very good area. And a number of the other industrial subcategories also look quite good. I would echo Bernhard's comments about energy. We don't see anything terribly attractive in this category right now. I think that it's kind of static. And if you are to participate in this group, then I would do so with companies that offer some kind of an attractive dividend, because I think it's going to be a total return with maybe the accent on the dividend, at least over the short term, maybe longer term as well. But it does seem that the Trump administration mandate is to try to bring down the cost of energy across the board. So I think this is going to impact energy. By the way, going back to the industrials, one other subcategory that I do want to mention that is coming up here very nicely, and it's kind of I would say a subcategory of agriculture in a sense, but they fall under industrials, are those water-related companies, the more industrial related companies, whether it's flow control, metering, purification. Water, to me, looks like one of the hotter commodities right now, and I'd probably be more inclined to invest in water-related than oil at this point.
Thank you. Appreciate that. Listen, I'm going to push a little bit for both of you before I pivot to another topic that's related, but yet not on the same, call it question, in that we all know that AI is coming. We all know that it hasn't been implemented even to the 15-yard line of a 100-yard football field. But yet the energy that's going to be needed for that implementation is something that we're not even scratching the surface on. Now, even if we have a magician in Washington that can get cost of energy supply down, how do we not play that sector to maybe a middle of the road emphasis versus a maybe overweight? It's a question. I'm not sure that it's clear, but do you follow me, Bernhard?
Yeah, no, look, look, we have exposure into power, so certainly power, and then you always, it's just oil producers or oil and gas producers. That's where you want to be a little bit careful, just because the commodity price, the global commodity price, is really what kind of drives their multiple or the stock. So we want to be a little bit careful about the near-term impact of what's going on geopolitically with the commodity price. And I would say, if we have peace in the Ukraine, if they get that deal done, and it looks like it's going to happen, oil prices are going to come down, which is what, Trump wants, because he wants lower input costs. But if you're a producer, that's not good for your revenues. So then we pivot over to the people that consume oil and gas, which is gas turbines that make electricity. So that's where there are plenty of producers that are really interesting on the utility side, actually. And it's interesting that the utility index went way up because there's power production inside of that. That's really interesting. So typically when interest rates went up a lot, utility stocks don't do very well, but it became a power play, power basically based on the AI. But also, I mean, look, there is efficiency being built into the chips as well, with the DeepSeek moment, where now open models are going to be much more used. You don't need to use the high-end NVIDIA chips anymore to run a lot of those models. And it's not a Chinese thing. It's the open models are now being used everywhere. I mean, Amazon has just launched an open model. At Google, you see the same thing at Google Cloud. They're launching open models because it just basically gives the companies that don't need quantum type computing power, but just need just very pedestrian type tasks done in their network, the ability to do that. And that's kind of made everybody rethink, okay, how much power do we need down the road? I mean, certainly, when you look around New York City here, we need to upgrade our power grid. That's something that certainly is given. But some of the froth in terms of multiples went out of that sector, and we have to be a little bit careful. But it's giving us opportunities to buy those dips.
Understood. Very good. Thanks for clarifying. So the impact on this open AI versus closed, how does that affect the chip sector? If you don't mind expanding out, either of you.
It's affected it badly in terms of the stock price, because all of a sudden the notion was, okay, we don't necessarily need the high-end Blackwell chip from NVIDIA. We can do it with something that's a second-class AMD chip or something else that is a more commoditized chip, rather than running the high-powered stuff. I think that's a little bit of an overstatement, because running that high-end computing stuff, you still need the very high-end chips. So the Blackwell chip, the numbers, as you said, were phenomenal out of NVIDIA. I mean, the earnings per share were phenomenal, but Jensen Huang made a statement, well, the future, we don't know exactly, and then the market sold it off, but the numbers were terrific. So the demand for these high-end chips is they're sold out for the next 5 years. And it's a question of, can we produce enough chips? But now that there's an alternative, there's a lower end AI, so to speak, that can be utilized. That's kind of a game changer for most companies. And that's why some of the air has come out of the semiconductor sector stocks.
I'm just going to comment, those that have heard us talk about the gold rush. There's always a gold rush. It was the internet in the early 90s, which I had front row seats for, watching how that developed and created bubbles, and of course the different areas that didn't perform, the ones that still last. We've learned from that. You can't put a price tag on experience, which is why I leverage these folks on the front lines in different areas. But you also have the impact of this new technology and how it's going to ultimately play into all of the other factors that we want to make sure that we're taking into consideration. So, just I think described, understood, and I also think the demand for chips isn't going away. It's a question of which chips. And if you go back to the gold rush, you remember that the picks and shovels that were sold to these folks out there mining gold were the ones that made out the best. So if you're selling to AMD and NVIDIA and all the others that are making chips, regardless of whether it's the Blackwell or the lower technological chips, those are the ones that are going to continue to sell regardless of who's the winner in a particular demand. The other thing I've learned, and whether it's the manufacturing sector or in any other sector of the like, when you can't get something, you order double of what you need. And then when you can get it, you cut your orders down. So I think some of this is hanging over us and concerning us, but I think the numbers don't lie, and the demand for AI and chips is not going away anywhere near term, and 10% has been utilized out there in the way of approaching life. And I will sit back and say, I remember sitting in, the learning chair, if you will, in the new, call it rookie advisor, working in the World Trade Center in 1995 and 1996, training and learning from folks that were kind enough to give us the wisdom to be where we're at today. We don't have any idea how this is going to affect us. We could sit back and say, this is going to happen, that's going to happen. I remember hearing the same thing in the 90s, and yet here we are with the outcome of what no one predicted. So we get up every day, we make sure that we're cognizant of factors that we didn't think of the day before, we get stronger from our experiences, we leverage our network, and we continue to guide counsel and make sure that we're doing the best we can, because none of us has tomorrow's paper. So I'm going to ask each of you for closing remarks before I have a call to action. So who wants to go first? I don't want a fight to break out here. Who chooses?
Well, I went first before, so let Bernhard start.
So look, I mean, we're living in more volatile times for sure, and that's creating a lot of anxiety with clients and with investors, and that's normal. But I always say I embrace volatility as long as it's on the upside. So we continue to like the environment. One thing I would add to our conversation is take a look at international stocks. Okay, there's a big opportunity in international stocks here. If you look at the German stock market, for instance, or any of the European companies, they're outperforming the S&P by a really wide margin. And it's really the catalysts are peace in Ukraine. I mean, the impact of the war in Ukraine on the German economy has been devastating. If you think about cutting off the low-cost energy to Germany, the German economy, but it's also now the whole Doge and the new, I would say, realignment of the Western alliance has created a totally different scenario. So if you look at defense stocks, I mean, Gene said there's a big opportunity in defense stocks. Look at the European defense contractors and what's happened to their stocks just in the last month. So when you do Jeff's team does the best asset allocation, I think, on the planet. You guys do a great job in that. Look at your international allocation, and the valuations there are fantastic because Europe and the rest of the world has been a terrible place to be in the last couple of years. That means the multiples are really low. So any positive catalysts, we're getting now, you have the German economy going from negative growth to positive growth. You have the possibility of peace. You have massive investment in things like defense. Okay, that creates catalysts for economies like in Germany. So I would say, just as a closing comment, when you're looking at your diversification, which Jeff correctly pointed out, diversification is so important in this environment. Put some of your asset allocation into international. There are some great opportunities there.
Thank you, Bernhard. Very good. We haven't talked international in years due to the tax code being more favorable, but valuations are a major factor as well. Appreciate that. Gene.
Well, the sentiment at this point is pretty sour, if not dire. And the AAII sentiment survey, I think, really reflects that. The velocity of change in the bearish sentiment is just really noteworthy. I haven't seen anything like that since after the financial crisis. So as the savvy and smart investors over time have often said, the best time to buy is when nobody wants them. And this tends to be that period right now. Investors' outlooks are clouded by the tariffs and by Doge. And if you think that they are insurmountable factors, then by all means, you'd want to stand clear of the market for an extended period of time. But if you believe, as I do, that these are two very important factors for the long term that will help to align the economies, not just in the US, but globally as well, into being more streamlined, being stronger, then I think now is a pretty good time to be looking at opportunities in this market. And we always like to say, don't diversify for diversification's sake. Don't try to hit all the different boxes and be in every sector and theme. What I found to be more successful is to really identify the 3 to 5 best performing or likely to be the best performing sectors going forward, and really focus and concentrate in them, but be careful not to concentrate in any one particular position or in any one particular sector or theme for that matter. Try to balance out among those 3 to 5 sectors. And I think over time, that strategy will do quite well. So as I mentioned, I think the outlook here is very good. Our Dow Jones Industrial Average target might seem pretty lofty here at 50,000, but I think that it is something that can be achieved, because as the Doge really becomes more clear and understood and implemented, then I think that investors will see the benefits, not just for the short term, but for the longer term as well.
Excellent, both of you. I'll summarize briefly. I've kept you on longer than normal, but I've had 2 exceptional minds willing to share their vision and guidance with us. So I didn't want to leave any stone unturned with the time frame we had. But a couple things I'm going to leave us with: diversity, but methodical diversity, well thought out diversity, making sure that we have I think 2 objectives, right? Enough liquidity to get us through the near term. And I always use the analogy 3 to 5 years for unforeseen or just fixed expenses, being able to overcome that. Having lived through the 08, having lived through the dot-com bubble, having lived through 9/11, I know how critical it is to have liquidity. And sometimes you think you have enough, but you need to have more. And then secondly, what's our ultimate objective is to make sure the wealth that our clients that we care for and the folks that we're in charge of is making sure they're combating inflation and making sure their money is working, so that when their legacy, their next generation, or later in life when they're utilizing their accumulated wealth, is going to have the same or better purchasing power. Those are our objectives: protecting ourselves, protecting our assets, reducing our expenses as much as we can, staying diversified, and then finally staying invested. You think that you're going to be able to time the market? I've been doing it for 30 years. Come teach me, because I haven't figured it out. It is going to be violent when it recovers. When we realize the tariffs may not cause the dramatic impact that what's being predicted as the worst case, or when we get the solving of the issues that we have globally, and whether it be Hamas and Israel, or Ukraine and Russia, or whatever it is, that when it happens so quickly, and there's no chance you're going to catch it. So make sure you have identified your short-term needs, your intermediate-term needs, your long and legacy needs. Build a strategy that aligns to the objectives and this willingness to take risk and stay the course, and leverage the smartest minds in the world, which many of you have joined us to be a part of in previous. I'm telling you, they were chosen for a reason. Gene is the best at what he does, and Eugene and Bernhard is the best at what he does, coming together. And thankfully, no cat fights broke out. I appreciate you both. I appreciate everybody joining us. Be well, and we'll see you soon.